Everyone is worried about inflation right now, from small businesses to investors to politicians. Since about a year or 18 months ago, inflation has been a big worry and a big topic of conversation. In this video, we'll go over a hierarchy of different types of investments and how they rank when inflation is high. All of this is what Warren Buffett says. He is 91 years old and has lived through inflation, so he knows a thing or two about it. Cash is the worst thing to invest in when prices are going up. Even Warren Buffett doesn't like holding cash when prices are going up. Ray Dalio, another billionaire, has said cash is trash, which is a memorable and catchy way to say he doesn't like cash. This is because when inflation is happening, the money you have in a savings account or on your dresser at home is worth less and less every day, week, month, and year. One of the most important things we want you to get out of this video is that as an investor, you need to think about your returns and what is called real terms. Your real return on investment is easy to figure out with simple math. Let's say you got $10 back from your investments every year. To figure out the real return on your investments, you have to take inflation into account. So, if inflation is 7% that year and your investments give you a 10% return, your real return is only 3%. This is why cash is at the bottom of this list. It gives you almost no return when you hold it. When you keep cash for a long time, inflation can hurt you. Bonds with a fixed interest rate come before cash on the list. Conventional investing wisdom says that these investments are very safe, but Buffett would say that when inflation is taken into account, these investments aren't all that safe. At the moment, a 10-year US government bond has a yield of about 1.8%. This means that if you bought a 10-year government bond today, you'd get a return of 1.8% every year for the next 10 years. Let's say that inflation averages 4% over the next 10 years. This isn't too far-fetched, given that the most recent report put inflation at 7%. Taking into account the effect of inflation on your return, this means that your real annual return would be negative 2.2 if inflation was 4%. This is better than just holding cash, but it's still not the best. During times of inflation, people who own fixed-rate debt like government bonds lose money. On the other hand, people who borrow money for a long time at a fixed rate do better when there is inflation. Buffett calls assets that don't make money unproductive assets. They come next on the list. This includes gold, silver, and other valuable things. Now, these aren't terrible things to own during times of inflation because if everything else stays the same as the price of everything else goes up, these things should, in theory, at least keep up. But these assets that don't make you money probably won't help you buy more things either. This is what Warren Buffett says about gold. If you put all the gold in the world into a cube, each side would be about 67 feet long. So, if you took all the gold in the world, you can make a cube that was 67 feet tall and went down there. That would be it. At today's market price, that same cube of gold would be worth about $7 trillion. That is probably about a third of the value of all the stocks in the United States. Now, these investors aren't just trying to keep up with inflation. We want to make investments that do better than inflation and give us a real return. Here comes into play what Warren Buffett calls productive assets. Now, everyone knows what Warren Buffett got rich by buying stocks and whole companies. But Buffett says that not all businesses are the same. The next most important thing in the order of inflation is productive assets and average businesses. There are a few things that most businesses have in common. One is that these kinds of businesses need a lot of extra capital, which is just a fancy word for money to keep going. Ticker for United Rentals symbol URI is the biggest company in the world that rents out equipment. United Rentals' business plan is pretty simple. They buy equipment that is usually used in building projects. Things like bulldozers, portable toilets, and big trucks. United Rentals then rents out that equipment to construction projects for a short time, usually the length of the project. The equipment that United Rentals rents out to its customers isn't going to last forever, so it needs to be replaced every few years or so. Let's say, for the sake of simplicity, that each bulldozer the company buys costs $1 million, and that over its lifetime, it can be rented out to customers and bring in $1.2 million in sales for the company. But for the sake of this example, let's say that inflation is 20%. This means that when the company needs to buy a new bulldozer to replace the one that it already has, it will have to spend $1.2 million. Look at what's going on. The business can't give the company any money in the form of profits. All of the money that United Rentals makes in profits has to go right back into the business to buy new equipment to replace the old equipment. But this shows how hard it is for businesses that need a lot of money to run when inflation is high. There are two types of businesses that do well. One is the business where all of the reported profit just sits there, and there is extra cash at the end of the year. You can take that cash out of the business and it will do just as well as if it had stayed there. The second business makes money, but there's never any cash on hand. The next type of average business you want to stay away from is one that doesn't have what's called pricing power. Let's say a company only makes plain white t-shirts with no logos or designs. Someone will just buy the cheapest white t-shirt they can find, so this company has no pricing power. This t-shirt company can't raise prices higher than its competitors either, because its prices are already higher than those of its competitors. People will just buy white t-shirts from this company's competitors instead. This company will have a hard time in a world where prices are going up. The cost of the materials used to make the shirts is going up, as are the costs of paying the people who make the shirts and shipping them to customers. The price the company can charge for shirts is the only thing that isn't really going up. Now, do you see why inflation is so hard on companies that can't set their own prices? Now let's talk about the next type of investment, which we'll call productive assets. Here's an additional example. Let's say instead that our friend John uses $1 million to make a piece of software that makes it easier for people to make videos on YouTube, let's say John makes $1.2 million from the product in the first year, which is a $200,000 profit. It gets even better. In this example, let's say there is also 20 inflation. John can charge $20 more for his software this year than he could last year. This means that John's sales of $1.2 million last year were worth $1.44 million because of inflation. But the good thing about John's software business is that he doesn't need to put any more money into it. He already has the software, and he may have to spend a small amount of money to keep it up to date and running well. This is the opposite of a business that needs a lot of money to start up. This software business of John's is called a capital-light business because John won't have to keep putting a lot of money back into the business just to keep it running and making money. This means that John can take his profits out of the business and not have to keep putting them back into the business to keep it running. You want to find a firm that requires little cash. These are firms that do not need to constantly reinvest big sums of money in order to expand. These are frequently firms with very strong brands. Apple, Coca-Cola, and Buffett's own Seeds candies are examples of such companies. Other types of firms with modest capital requirements include those that do not rely on holding a large number of physical assets, such as factories or physical goods. Considering Microsoft, Facebook, and other technology-focused companies, almost any software company fits under this category, because once the program is built and the money is spent on producing it, the reinvestment back into the business is modest in comparison to most enterprises. Pricing power is another important aspect of a corporation to own during times of inflation. Here are some ideas to get you started. One useful exercise is to imagine how a client would react if the company increased its prices by 10%. When prices are rising due to inflation, you want to own shares in companies that can readily raise their pricing for their goods. You should avoid investing in companies in commoditized industries that have difficulty raising pricing even in normal times. Warren Buffett stated that the finest investment is not having to constantly re-educate yourself to be that in today's terms. You paid for your skills in old dollars when you went to medical school or law school, and you don't have to keep reinvesting. You also keep your earning power and present dollars. Investing in oneself is the best way to protect against inflation. If you are the best at what you do, whether you are the top mechanic, lawyer, dentist, plumber, or accountant, you make yourself extremely valuable to others. The benefit of being highly valued in the marketplace economy is that you can charge whatever you want for your services and your clients will gladly pay for it. What are your thoughts on the information that Warren Buffett just revealed? We are interested in what you have to say. We would appreciate it if you can leave us your comments so that we can learn how helpful you found this video.